Small cap stocks continue to lag the broader market. In the 12 months to the 31st of May, the Small Ordinaries Index added 3.6% compared to the broader market's 11.1%. So, why are small cap stocks lagging, and what is required to get them moving again? And, given the underperformance, are there any stocks or components that look like outstanding value? Simon Conn is a Senior Portfolio Manager with Investors Mutual, which operates one of Australia's best small cap funds, the Investor Mutual Small Cap Fund. He joins me now in the studio. Simon, welcome to the program.
Yeah, thanks, Paul.
So, why have small caps lagged the broader market?
Yeah, look, it's a good question, Paul, but I mean, I focus more on the particular stocks. So looking at the broader index, I think, is always a bit problematic because there is a big exposure to mining, gold in particular, and a lot of domestic cyclicals in the small cap sector. So I think you can still find really good quality companies that are doing good things and continue. I think can continue to grow in the next couple of 12
months. Okay, I might come to some companies that I know that you like at Investors Mutual, but just before that, I mean, what could give the small caps index and the broader that a bit of a boost? What does it need, do you think?
Look, I suppose gold's a big part of that index, so the gold price does drive a large component of the index, but also there's quite a lot of domestic cyclicals. So domestic retail is a big part of that sector, and obviously a lot of those stocks have fallen quite heavily with the softness in retail sales recently.
So a stronger local economy, gold, also weaker Australian dollar, would that be an aid to the sector?
Most small companies tend to be focused more on the Australian economy, so it can tend to be a headwind for the domestic economy.
Right, okay.
Domestic small caps.
All right, now let's look at some of the stocks that you like in particular. So let's deal with the first one in the news, I guess, because of the media reform, and that's Southern Cross Media. So
yeah, sure.
So maybe you can explain, that's stock code SXL, why that's on the radar.
Yeah, look, I mean, Southern Cross is a stock we've covered, watched for quite a few years. I think importantly under Grant Blackley, the new managing director there, the balance sheet's been improved significantly, so debt has been paid down significantly. And effectively at its heart, Southern Cross is a radio business, so about 80% of the business relates to the hits and Today Triple M networks and also in the regional area under the Southern Cross banner. So 80% of the earnings are from radio. Radio is not a high growth business, but it's a pretty resilient form of medium. It's pretty, it's alive and it's immediate. And it's a media form that continues to do okay. Obviously, the second half of this year, they're comping a period which was quite strong last year, so they've sort of forewarned a bit of a softness in the market. But we don't think that foretells structural issues with radio. I think it continues to be a very relevant media form. It continues to generate good cash.
So for you, it's not about media reform and perhaps sort of, that might be one of the benefits, but you actually see the earnings stream coming through, particularly from their radio network, as that's the main reason why you're investing?
Absolutely. I mean, it looks cheap on the fundamentals. Yep. Balance sheet's good. P of 11 times, yield of 6%, fully franked. I think those are good, compelling numbers. Look, it'd be nice to get some M&A opportunities with media reform, and that's always a potential. But certainly in those sort of prices, you're not baking in any upside from that. But clearly it could be a potential tie-up partner for other media companies if media reform does eventuate. So
you'd probably see it as a reasonably low-risk type, given that you've got the optionality of a media reform, that sort of might be the bonus, but you think that the stock washes itself just in terms of the earnings outlook?
Absolutely, absolutely. And the other part of the business, obviously, I didn't mention, but was the regional rebroadcasting of Channel 9. So they've switched from broadcasting Channel 10 to Channel 9, which is a fortuitous and
stronger network.
Yeah, much stronger, particularly now that Channel 10 has issues in terms of funding content. So they'll put their regional affiliate Channel 9 in a much better position over the next 6 to 12 months.
Okay, let's look one in the pharmaceutical space, Mayne Pharma. It's been a lot of people's list, but it's had a mixed checkered record, hasn't it?
It has been volatile over the last 6 to 12 months. Yeah, it's fair to say. So I mean, they raised money for the Teva acquisition about this time last year. That was quite a significant transaction where they paid something like 900 million Aussie dollars for the Teva portfolio, which is broadly an oral contraceptive generics portfolio.
And they raised that money at quite a lot higher price than the current.
Yeah, about $1.38 to $1.45.
Currently,
stock ran up to $2. I think obviously, in hindsight, got significantly overbought. But it's fallen significantly now to around $1, which at those sort of prices, it's on a P of 11 times. It looks very cheap. I think it's a business in a low-growth economy, Paul, which was we've been saying for some time. It has characteristics that I think going forward over the next 2 to 3 years can deliver some earnings growth. It is a generics business, and there has been some pricing pressure in that part of their operations. But importantly, there are other legs to the chair. They've got a contract services business, which helps other companies get their drugs approved by the FDA and then into the manufactured and then into the field. And there's been quite a bit of M&A in that sector at very attractive multiples, 15, 17 times EBITDA. So there's significant value there, and that business continues to grow. and they also have a branded portfolio of drugs, which they're bringing to market. And as those drugs are approved, they come to market, they generate quite resilient earnings, and they can continue to grow that side of the business as well. So I think people have unnecessarily focused on one facet of the business, which is the generics business. But there's large components of the profit come from other parts of the business. And we just think at sort of 11 times it looks very cheap, and I think it's misunderstood and mispriced in this market.
So that's stock code Mayne Pharma MYX.
Correct,
the third is Tox Free Solutions. Just explain what Tox Free. Great name, Tox Free.
Yeah, it is. Well, obviously speaks to what it does. It's a hazardous and industrial waste business. The business has its origins in Western Australia. Very strong presence in the Western Australia by history, and they've used the cash flow from their operations in WA. To come on the East Coast, and they've made a series of acquisitions here in New South Wales and up and down the East Coast to build a very similar business to what they had in Western Australia. Obviously now through acquisitions they operate a much more diverse business, and the key asset and the key thing we like about the business is it operates very hard to replicate assets. So they have toxic and industrial waste facilities spread up and down the East Coast and obviously in Western Australia.
But those waste facilities, they're mainly servicing resource companies, is that?
So I think this is a misunderstanding. So in Western Australia, obviously a large part of the industry in Western Australia is mining related, and so they have benefited from the construction phase going back 2 to 3 years, last 4 to 5 years from the construction phase of the mining boom in Western Australia. But on the East Coast, their customers are large industry, so aluminium refineries, healthcare companies. So they've got a business called Daniels, which operates in the healthcare sector, services a lot of the public and private hospital businesses on the East Coast. So they're much more diverse than just Western Australian-based toxic waste facility.
And I think that's one of your largest holdings, if not your largest holding.
Yeah, it is because it has those characteristics we look for. Strong recurring earnings and a strong competitive advantage.
It's currently around about $2.34, I think. Do you have a sort of target on that, where you think value for that stock is?
Yeah, look, our analyst has got a $2.80 to $3 target price in the short term. But if you look at the comparable companies overseas, they trade at significantly higher prices because they generate very resilient, predictable cash flows, and trade at much higher EBITDA multiples. So this is stock sort of on 6 to 7 times. The comparable companies are on sort of 9 times in the overseas markets. So strong barrier to entry, and should generate good cash going forward.
There's 3 very different businesses: media, pharmaceuticals, and waste management.
Yes.
Is that part of the strategy of a diversification and portfolio diversification across the industry, or just the way that those stocks sort of turn out in terms of the pricing metrics and the outlook you have for each stock? Well,
look, I think our track record speaks for we're good quality stock pickers, so we focus on good quality businesses that can do well, not necessarily regardless of the cycle, but sort of independent of the cycle. And so it really becomes down to a stock picking basis. So we look for companies that are reasonably priced. It just happens that these 3 stocks are very reasonably priced in the current market, and we think they all have initiatives where they can grow their earnings over the next 3 years, either through cost outs, further acquisitions, bringing new products to market with the instance of Mayne Pharma. So we think that they have the characteristics you look for. So it's really about focusing on the stocks, not so much on a big over broad macroeconomic picture.
Okay, Simon, thank you for sharing those 3 stocks with us on Switzer. That's Simon Conn from Investors Mutual. After the break, with only 10 days away till the end of the financial year, we'll turn to Graham Colley for tips on how to prepare for the super changes, and in particular, what to do if you're in a situation where you've got more than $1.6 million in the pension phase. Stay with us on Switzer.